It is the last major economic report before next week's Fed meeting. The Consumer Price Index is out tomorrow morning. Let's bring in Michael Schumacher, Global Head of Macro Strategy at Wells Fargo Securities. Mike, great to see you. What's your outlook? What's your outlook for the market reaction?
Slightly above consensus. So our econ team and Sarah House
So hotter.
A little bit, yeah. 0.25. People like to think about that second decimal place right now. I know it's kind of crazy, but still, that's the way it goes. So just a touch above consensus. But I do think that inflation genie is just about back in the bottle. It's a lot more about the topics you all were just discussing. Consumer, recession, growth, that's where the market focuses now.
So 0.25 would make it seem like then 25 basis points would be in the cards for the Fed, much more so than
50.
Than 50.
That's right.
Yeah.
Whereas if it comes out at, say, 0.1, party on. 50 is pretty likely.
Right.
Jay Powell's all excited at that point, and you've got markets doing a victory dance. But, yeah, 0.25 would be a little bit challenging.
So you think the markets would rally more on a 50 basis point cut? Or do you think
is that careful
right.
what you wish for?
Exactly, exactly.
Right. So is good news or is good news bad news? And I'd say in the near term, people do look at the Fed, and markets are taking their cues very much from Fed expectations or other central bank expectations. So it's look at the data, think about the Fed's lens, how does the Fed see it, and then react. That's how the markets have been going.
So it's a little bit of a Rubik's Cube, right? You get the green side fixed, but then the red side screwed up. And so, and I say that in terms of jobs and inflation because, maybe they figured out the inflation portion, although I'm not convinced. But on the flip side, as we were just talking about, Julie's concerned about, as am I, it's the employment side that's going to do escape velocity. So they may fix one at the expense of the other. And so where are we on the employment side of things? Because that's the next story, I think.
Yeah, the employment indicator has been lagging. So our econ team likes to point to lots of other indicators. So do we. If you look at the quits rate, if you look at JOLTS, et cetera, they've been weakening for quite some time. And we finally had this uptick in unemployment. And then from the clients I talked to, it really caused a big stir when it triggered the SOM rule. So a bit more than a month ago, people said, oh, wow, it's a great indicator. It's 0.5 now. That's bad. So now people are looking much more tightly, I would say, at the employment indicators than they had been. But you don't get the next report for a while. So tomorrow, yes, all about inflation with this little debate thing, I believe, is tonight as well. So that may get some attention. But I do think you're right, though, Guy. It's going to shift back to the labor market pretty soon.
So, Mike, just addressing the politics of it, do you think that plays into the 25 or 50 that the Fed is contemplating? Whatever, we'll see the data, of course, but is that an element that moves them?
Probably not in the near term, though, Karen. I think longer term, if you say, well, what if Donald Trump wins? Forget the debate, but the election. What's the likely configuration of Congress? Probably it's unified Republican control. What does that mean? Bigger deficits. The Fed says, oh, lots of deficits, lots of fiscal support. We, the Fed, probably won't need to cut as much. Whereas if Kamala Harris wins, yes, Democrats could win the Senate, but it's a much tougher row to hoe. So I'd say in that case, you get more likely the Fed thinking, probably not going to get deficits as big. We then have to cut a bit more. So down the road, it matters quite a bit. The markets may shift their probabilities a little, depending what happens tonight, but not a huge amount, in my opinion.
So just looking at the various scenarios and what you think is most likely, what is the best case scenario election-wise for the markets? And I know it's early going. There's a lot of road between now and November, but still, I mean, from clients, what are you hearing?
Markets like divided government, and they'd like to see more fiscal restraint. You just haven't had it in Washington in quite some time, and not even just in the U.S., but in other countries as well. So some lineup where it is divided, that's the best, whether it's Democrat in the White House and Republicans having the Senate or some sort of other scenario. It doesn't matter so much, but divided is what people want to see.